Hi traders, and welcome to another video. In this video we will show you how the markets move. Along the way of your trading journey, you will learn that the markets can only move in two different ways: trending and consolidating. When markets are trending, they can go up, that's what we call an uptrend or a bullish market or a bull market, or they can go down. This is what we call a downtrend or a bearish market or a bear market. A consolidating or sideways moving market is a market that is trading in a range, making fairly equal highs and equal lows, until it's ready to break the consolidation to the upside or to the downside and start trending again. Remember, the market never moves in a straight line. Being able to define the current market condition, whether it's trending or consolidating, is a vital skill, so you know in which direction to trade. You will need to train your eyes and practice on how to identify this. It's really important that you master this. Okay, now what is a trending market? A price series that continuously closes higher or lower on average over a defined number of periods is said to be trending. An upward trending market is one that may fluctuate up or down, but on average closes higher. A downward trending market ends lower, regardless of any small moves in between. Trending markets may drift higher or lower, in ways that may or may not be explainable. Even random markets trend, but all trending assets represent trading and investing opportunities. Technical analysts study trends to identify when a trend may end, change, or continue. Here we have an example of an uptrend. Now, how exactly do we identify that? Well, an uptrend is a series of higher highs and higher lows, as we have here in this example. We have a low here at the bottom, which could be the end of a range or the end of a downtrend. That's not what's important. What is important is what occurs after that. By the way, we use a line chart to explain this because we have less noise and distractions than on a candle chart, and it's easier to see. So what happens next is price creates a new high. This still doesn't mean that this is an uptrend. There has to ring a bell now when you're a trend trader. What we see next is more important. Price creates a higher low. From this point we are in an uptrend. Of course, we don't know for sure that this is a new higher low until the new higher high has been created. But aggressive trend traders can place a trade on that first higher low if that fits their strategy. From there on, it's higher low, higher high, higher low, higher high, higher low, higher high, higher low. See how price then fails to create a higher high to continue the trend. The uptrend is changed in a downtrend when it broke that last low with a strong move down. Of course, to validate a downtrend, we would need to see a series of lower lows and lower highs, just as we saw with the uptrend, but turned the other way around. Now, what is a consolidation? Consolidation in technical analysis means an asset is trading between well-defined trading levels. Price movements are contained within certain boundaries, also referred to as a sideways moving market. Consolidation is generally interpreted as market indecisiveness, which ends when the asset's price moves and closes firmly above or below the trading pattern. This can be caused by several reasons. This might be because of a high-impact news release or a political decision. This is an example of a consolidation. As we explained in the previous chart, we identify a consolidation or a range by price trading between two certain levels. As you can see on this example, we have an upper and a lower band where price is rejecting from multiple times. It creates a high, then a low, and instead of creating a higher high like it would if it was a trend, it creates an equal high. This indicates that there are not a lot of buyers left to take price higher, or maybe they are just waiting for some big news to come out, or they are uncertain about their positions. There can be a lot of reasons. Price tries again but doesn't seem to manage to get above that level. it goes back to the bottom of the range and it goes on like this for a while. A range can last as long as it needs to until it breaks. We finally got that break to the upside and the trend continued. We can use these consolidations to our advantage. Now how we will do that is for a later video. We have learned that the markets can move upwards, downwards and sideways. So to understand what a pullback is, let's take the example of a downtrend. As we know, when the market is trending down, the market makes consecutive lower highs and lower lows. In all trends, there are going to be moments when the market is going to have to retrace, because the market cannot go in any direction forever without correcting. At these specific points, when the market pulls back to the previous low or any other important key level, that's what's called a pullback, correction, retracement or contraction. You don't have to remember all of them. If you remember one, that's fine. Also, when a trade reverses, it will almost never go from an uptrend to a downtrend immediately. Contractions will serve as a transition phase. The price move that happens after the pullback is called an impulse. It is often a strong and fast price move that resumes in the direction of the original trend. Meanwhile, you see that corrections are often slow price moves. Let's go over some examples so your eyes get used to spotting these different phases in the market. Let's show you an example of pullbacks in an uptrend. We first have an impulse to the upside, and then price finds a resistance level, causing price to consolidate for a while. When the correction ends, we can see a strong impulsive move back to the upside, before hitting a new resistance level. We can officially identify this as an uptrend now. We have a high, then a higher high, and now we are supposed to buy the higher low to catch the next impulsive wave up. The pullbacks offer nice opportunities to enter a trade that you might have missed or even add positions to your existing trade. Let's continue. After the higher low during the second contraction, we have an impulse to the upside, followed by a long contraction. The curious thing is the next impulse. Normally, the longer the contraction lasts, the stronger the impulse, which is not the case here. Again, proof that the market isn't all black and white. But it's a good thing to know, right? Long consolidations predict big impulses. The markets give us so many clues along the way, we just need to be open-minded enough to see them. After our impulse, we have another contraction, followed by the next impulse. See how the impulses get smaller? That's often a sign that buyers are less aggressive and that the trend might end or reverse soon. Also, pay attention to the time a contraction lasts in comparison to the impulses. Markets are only trending for about 20 to 30% of the time. The rest of the time they are consolidating. Then we see another small contraction followed by a nice impulse. Another tip we would like to share is the smaller the pullback, the stronger the impulse. Most of the time. Deep retracements predict small impulses. After that last impulse, we had another pullback. Notice how price didn't manage to make another high afterwards. This is a red flag for any trend trader. And as you can see, price began creating downward impulses, breaking previous lows. This is where price action and market structure and all the other good stuff come in. But these lessons will follow soon enough. Being able to identify pullbacks will help you as a trader. It will help you to understand the direction that the market wants to go in. It will also help you determine if the market is just pulling back or completely changing its course. As you can surely understand, pullbacks are key to identifying good trading opportunities. Traders and investors want to enter the market at better prices and wait for the retracements to give them some kind of discount. Continue to practice this and look at the market to identify impulses and pullbacks in order for you to find better opportunities to buy and sell at. And as always guys, thank you for your attention and we'll see you in the next videos.